All right, let's dive right in. Today, we are getting into one of the biggest debates in all of finance. Is the stock market this perfect, all-knowing machine, or is it actually kind of messy, full of flaws that smart investors can take advantage of? I'm telling you, this isn't just theory. The answer to this could totally reshape the way you think about investing.
So let's just cut to the chase, right? Is beating the market even possible? Or is all this time we spend picking stocks, doing research, is it all just a big, elaborate waste of time? This is the fundamental clash between Wall Street pros and the academics, and we're about to unpack it.
And that brings us to what's called the efficiency paradox. You've got these two camps. In one corner, you have the perfect academic theory that says markets are super efficient and all information is priced in instantly. But in the other corner, you have the actual investors, the pros, who are out there making a living because they believe there are always opportunities, always little cracks in the system.
So let's look at these two views. The perfectly efficient camp says, look, all the news, all the earnings reports, it's all baked into the price the second it comes out. You can't beat it. But then the efficiently inefficient view comes back and says, hold on a second. Research costs real money, it takes real time. There has to be a profit incentive, a reward for doing that hard work. Otherwise, why would anyone bother?
And this is the core of it, the Grossman-Stiglitz paradox. It's a real brain bender. Think about it. If markets were truly 100% perfect, nobody would have any reason to do research. But if nobody's doing any research, how on earth could the market possibly be efficient? See the problem? This paradox basically proves that for the market to work at all, it has to be a little bit broken. There have to be some inefficiencies to exploit.
Okay, so if we're on board with the idea that the market has some flaws, the next question is obvious. How do we find them? And it all starts by asking yourself one single, incredibly important question every single time you think about placing a trade. Who is on the other side of your trade? Seriously, every time you click buy, someone else is clicking sell. You need to have a really good reason to believe you're the smart one in that transaction. What do you know that they don't? Are they panicking? Are they forced to sell for some reason? Or, and this is the scary one, do they know something you've missed?
So to help answer that big question, there's a really useful tool called the BAIT framework. Think of it as a checklist for identifying the 4 main ways you can have an edge. It's how you can pinpoint your specific advantage in any given trade.
The BAIT framework gives you 4 potential sources of an edge. It stands for behavioral, analytical, informational, and technical. Let's do a quick run-through of what each of these really means.
First up, B is for behavioral. This is all about human psychology. You're taking advantage of the fact that people can be irrational. They get greedy, they get scared. When a market panic hits and everyone is dumping great companies for no good reason, your edge is being the calm one in the room, buying when everyone else is selling.
Next, A is for analytical. Now, this is where you're using the same information as everyone else, but you're just better at it. Maybe you've built a more sophisticated model, or maybe your edge is simply your time horizon. While the rest of Wall Street is totally obsessed with next quarter's earnings, you're taking a 5 or 10-year view. That's a huge analytical edge.
Then we have I for informational. Now, this is about digging up unique insights that other people just don't have. And we're talking about legal stuff, of course. It's about pounding the pavement, maybe talking to a company's customers or suppliers to get the real story, instead of just reading the same press releases as every other analyst. It's about doing the homework others are too lazy to do.
And finally, T is for technical. This is a fascinating one. This is when people are forced to buy or sell for reasons that have absolutely nothing to do with whether the company is good or bad. A classic example is an index rebalance. When a stock gets kicked out of the S&P 500, every single index fund has to sell it all at once. That forced selling can push the price way down, creating a massive opportunity for you to step in.
Okay, so now that we have this BAIT framework in our back pocket, let's look at what's happening in the market right now. Because, some really big structural changes are happening, and they're creating brand new opportunities to find these edges, especially if you're a long-term thinker.
You can boil it down to 3 huge shifts. First, the incredible explosion of passive index funds. Second, the fact that so many active managers are now playing a super short-term game. And third, the massive return of the individual retail investor. All 3 of these trends are creating a sort of vacuum, an opportunity for people willing to do that deep, long-term work.
And just look at this. The share of trading coming from retail investors has literally doubled in about 15 years, going from 10% to about 20%. That is a gigantic structural shift. And it means there's a lot more behavioral and technical-driven trading happening, which, if you're savvy, you can absolutely use to your advantage.
Okay, this all leads to a really critical and frankly mind-blowing point about how wealth is actually created in the stock market. It's not just about finding any old edge. You have to understand just how brutally concentrated the returns really are. Brace yourself for this number. Since 1926, just 2% of all publicly traded companies have been responsible for over 90% of all the wealth created in the stock market. Let that sink in. 2%. In fact, most stocks actually end up losing money over their lifetime. This is the power law in action. A tiny, tiny fraction of superstar companies drive almost everything.
So what does this staggering fact mean for you? Well, it leaves you with two very clear choices. Choice 1, you buy an index fund. That guarantees you'll own those few monster winners, but you also have to own all the thousands of losers that drag you down. Choice 2, you try to hunt for those winners yourself, building a focused portfolio. The potential rewards are way higher, but guess what? So is the risk.
Which brings us right back to where we started. If you decide to play that active game, if you want to hunt for those incredible companies in that tiny 2%, then you absolutely have to ask yourself before every single trade, what is my edge and who is on the other side?